Headlines involving trade and tariffs have become an almost daily occurrence, and that uncertainty has not surprisingly been fueling volatility in the markets. U.S. equities are now down across the board year to date. The Nasdaq is down more than 10% since its peak in December. That puts it into correction territory. Now that's notable because a quick look overseas and you'll see the Shanghai Composite Index heading in a very different direction. It's up more than 3% year to date. So why are Chinese equities outperforming? Here to shed some light is Haining Zha, Vice President and Director for Asset Allocation Research at TD Asset Management. Haining, always great to have you on the program.
Thanks for having me.
I know we have several themes that we want to talk about today. Let's start with that outperformance for Chinese equities. What's happening there?
Yeah, it's really amazing. So if year to date, if you look at MSCI China, it's up 17%. In the same time, Nasdaq is down 8, S&P is down 5, and even Europe, who has outperformed recently, it is only up like 7, 8%. So this outperformance is really amazing, and I think it's important to highlight what is the underlying drivers of it. I think DeepSeek is obviously the easy one people can pinpoint. It is amazing progress, amazing breakthrough, because number one, it accelerated or triggered the acceleration of the deflation in the large language model. Deflation, I mean the price is getting cheaper and cheaper. In the meantime, it accelerated the usage of large language model in the application layer. So, and in terms of China, it's even more important because it actually showcased China's technological capability and forced people to reassess. And you know, people usually shrug it off any kind of progress in the Chinese industrial or the tech space, but this time they are seeing the real progress.
When we talk about that equity, so obviously DeepSeek, and you're talking about the deflation of costs for artificial intelligence. Is it only a tech rally, though, when we talk about the outperformance of Chinese equities?
It is actually more than a tech rally. So if you look at the real economy, probably we can talk about later on real estate and some of the other topics. But for real estate, we are seeing signs of life after 3 years of correction. And in other parts of the economy, on the micro level, those companies are actually actively doing buybacks, try to give more dividend to the shareholder, try to improve their corporate governance. So there are lots of story out there. But of course, the tech is the driving force. So if you look at the overall story, previously there is kind of only a one-leg stool. So people are betting on the policy stimulus and turnaround of the economy. But now all of a sudden, with this AI and tech, you have the potential tech breakthrough and you have the potential productivity boost. All of a sudden, you have a multiple leg stool, which is much more, promising.
Now, when I think about North American markets or even European markets, obviously governments have been dealing with inflation, trying to wrestle it back down to 2%. You say in China, there's a different setup there in terms of deflation, so perhaps a little easier for them to control costs in that economy.
Right, that's another interesting point. So tariff is basically a form of economic barrier that actually increase the cost for the flow of goods and service. So if the tariff is higher, then potentially it can cause disruption to all of those goods and service flow and make the overall system, global system, a little bit more stagnant. So when you put on tariff, it potentially could raise inflation. And guess which country in the world are in the best position to contain inflation? It is China, because right now it is actually having a little bit of this deflationary pressure. So a little bit of inflation actually help neutralize it. And also China accounts for 30% of the world manufacturing base. So, and it's operating very efficiently. So it is in the best position to control inflation. And now there is also this thing about the market. The market tend to reward scarcity. So for example, if you have growth scarcity, and if you're a growth company, the market tend to put a premium on your valuation. Now imagine a world when inflation getting out of control. Guess what? People might put a premium on the country or on the company who can better control inflation.
All right, so interesting points there on that point. You mentioned DeepSeek off the top of our conversation. While we've seen a lot of excitement around there, we've seen NVIDIA, some other chip makers in the West. We've seen even big tech companies in the Magnificent Seven really pull back. Has the AI trade moved from North America to China?
Yeah, actually, the DeepSeek, we think, you see after DeepSeek release, there's quite a bit of shock in NVIDIA share price and also the US tech in general. We think it's actually a preview of what is to come in the next 2 to 3 years. Potentially, that is the breakthrough in the Chinese semiconductor manufacturing. So right now, nobody is thinking about it because, honestly speaking, lithography machine and everything involved in that manufacturing process is the crown jewel of industrial production. It is super difficult to do, second to none. So that's why people always say it's impossible for China to handle all of the supply chain and be self-sufficient. I still remember back in 2018 when Trump initiated the first trade war and also the tech war, people say it at least will take 10 years to have breakthrough in the semiconductor manufacturing. But guess what? Now it's 7 years, and we are seeing some real progress. And if in the next 2 to 3 years, China really makes some breakthrough, then we could see massacre in the US semiconductor and the US tech. In the meantime, the Chinese tech could rally because the bottleneck is gone, and AI can further accelerate in China.
These are obviously the tailwinds you're looking at in terms of China's economy and the markets. What risks are there in the Chinese equity space right now?
Right. There are plenty of risks. For example, we believe the Trump's plan is to first tackle the Canada and the Mexico tariff talks, then probably move on to the Europe, and China will be in another bucket, which is, the tariff rate could be even higher because they are being viewed as strategic adversary. So if later on Trump further ramp up the tariff, of course, that's going to be a macro headwind. And also we are seeing this economic recovery in China. It is just showing signs of life. So in the face of macro headwind, there will be, the uncertainty will increase. But as I mentioned before, now it's a multiple legs to story. So we think the overall thesis is much more promising, particularly the long-term prospect.
Now I want to get into the National People's Congress. Just wrapping, you've got some key takeaways. What really stood out for you?
Right. So overall, the government still keep the growth target at 5% because in order to reach their long-term target, 5% is needed to reach their goal by 2030. But certainly the government is aware of the potential macro headwind and also the trade war. So that's why this year, all of the fiscal and monetary policy will remain very supportive and even more supportive than last year. So on the monetary policy side, we expect there will be another 30-40 basis points cut in interest rate and the 1% cut in the reserve requirement ratio to give more liquidity. And on the fiscal side, they actually upped the game compared to last year. For example, the official fiscal deficit raised by 1% more. And also on top of that, the special treasury issuance increased by about 300 billion. The local government bond issuance increased by about 500 billion. When you add all of those together, on fiscal policy alone, it amounts to about 1.6% net increase in terms of impact to the GDP. So I know the trade war is still going to be a headwind, but the Chinese government is preparing for it.
When we talked about the first block about AI, we know that it is energy hungry, even though this AI might be a little more efficient. Energy intensity targets. Take me through that.
Right. So they actually raised their energy intensity cut target from 2.5 to 3%. So this is actually another important point that the government is discouraging this notion of vicious competition because there is a bit of overcapacity going on within the industrial sector of China. So what the company does is they try to win at all costs, race to the bottom in terms of price. And obviously, this will do damage not only to the economy, but also to equity in general. So the government is proposing stopping this vicious cycle. And the way to enforce that, in combining with this notion of reducing the energy intensity, so they are going to keep the most superior, high-quality production capacity and try to reduce everything else. So we think it is a very tangible way of having a supply side reform. And if you remember, the last time they had such supply side reform, it was back in 2015 and 2016. At that time, nobody believed them, and they did it. And because they did it, many of the industrial goods and materials, the price, there is a notable increase. And particularly in 2016 and 2017, that corresponds with a boom market in China. So the market rallied up 60%, something like that.
Now, you mentioned earlier about the equity market rally that it wasn't just a one-legged stool. Yes, there's AI, there's tech, but there's a real estate bounce back. I want to make sure we get to the real estate conversation because this has been an overhang for China's economy. What is taking place there now?
Right. So as I mentioned before, the real estate market is showing a bit of sign of life. For example, year to date, the agents are seeing more showing and visits. And not only that, they are reflecting in the actual transaction volume. So in terms of transaction volume, in the new home market year to date, the floor space sold is up 2% versus down 20% last year. And in the secondary home market, the year to date, the increase is about 34% versus last year, it was only up 6%. So there is a quite notable increase. So for sure, there's going to still be a lot of uncertainty because there is still pressure in the economy. But if you look at the past big real estate bubble across the globe, historically, typically the real estate market go down something like on average, 40% over a 10-year period. China, within 3 years, it has already down 30% in terms of housing price. So now, obviously, the market is trying to find the bottom or find a trough. So if real estate sector stop becoming such a big drag in the economy, automatically that's another 1.5% to 2% boost to the GDP. So it's very significant.
We got about 30 seconds left with you, Haining. Is this, you've said signs of the real estate bottoming out. Is this sort of a circular thing too, where the consumer gets more confident about real estate, so real estate picks up and the consumer feels even more confident about real estate?
Yeah, part of the confidence coming from, not from the real estate price, because in terms of price, there is no signs of life. People still want discount. They are still under pressure. But when the equity market go up, that's where part of the wealth effect can be created. So of course, there is still going to be a lot of uncertainty, but we think people should pay attention to these dynamics.